Hello, hello. Welcome, everybody. I am so
Welcome,
excited
welcome.
to host this. Yes. Bob and
Yes.
Alan and I were just having a great conversation about their alma mater, so it's very fun. I would love to hear or even learn about anybody else's alma mater. They both went to University of Georgia.
That is correct. Best football school in the country and pretty good at academics too, but known for our
Yes.
football.
Yep, that's what you guys were saying. I'm from UCI, so we are not known for any of our athletics. I think maybe basketball, but I would never know. I didn't follow.
Yeah, when I was at Georgia, we won national championships in like three or four different sports, and no one ever went to those. It was football only, but like we were champions in gymnastics and equestrian, all those sports were free to go attend. So
Yeah,
That's
somebody,
great.
somebody told me at Harvard they would go around the campus and they would ask about the football team, and the answer from the students was, "Is it that time of year again?" Yes, I suppose it is. And you don't hear that a lot at Georgia. Georgia's that would not be the response you'd hear at Georgia.
yeah, I would say more often than not, we would stay for like 4.5 years. So we get one more football season. So you do what you should like save that one class for your last
Oh, that's
semester.
clever. That's very clever.
Yeah, I knew
Yeah.
dozens of people who pushed off job offers till January. So, all right, with that, we'll stop boring you all with our talk of football. So, welcome everyone. Super excited to be here today with the one and only Bob Veras. And so, I realized as I was prepping for this webinar that I have known Bob since I got into the industry, or known of Bob. I've gotten to know him over the years and did not know his background at all. And so, instead of me reading your bio, Bob, can you just sort of tell us your start in the industry, sort of what led you to where you are today?
Well, the best bio I've ever written was that I'm really sincere in trying to make the world a better place, and for that reason, some of my less heinous sins may someday be forgiven me. And that's the bio I prefer. But I got in this business when they made me editor of Financial Planning magazine before I'd ever balanced a checkbook. Not that people balance checkbooks now, but back then that was a thing. It was a boomer thing. And so I knew nothing about financial services and was editor there for 10 years, spent really rigorous learning the whole time. It was like the learning curve went straight up. You see these cliff climbers, and I was an intellectual cliff climber in this business. And I fell in love with the concept of financial planning. And I was alarmed at how different the actual execution of it was back then. Back then was mostly sales.
Yeah, Michael was telling me that part of your background and what caused you to leave Financial Planning magazine was sort of you digging in and maybe starting to understand some of that sales side a little too well for your advertising dollars.
Well, actually, he's garbled the message. We had a number of limited partnership programs that were big advertisers in our magazine. And somebody came to us and said, these are all garbage and they're going to hurt people and there are lawsuits waiting to happen. And this is one of the great lines of all time. I said, well, some must be better than others, right? And he said, oh, yeah, that's right. Some are better than others. It's like taste testing doo-doo. And so we started investigating all of our bigger advertisers, which is not a good business model, I don't think. And during that time, the board was aghast that we were doing this thing because mostly those people were selling that stuff. But what really led me to leave was the FPA and the AFP and the ICFP were talking about a merger, and they couldn't seem to get on the same page. And I did not foresee things getting any better. And it really wasn't. It was about 6 years later that they finally merged. No, it's 10 years later. 10 years later. And so I figured, I'm making these people look good. Why am I doing that? What should I, surely there must be a better group of people I can make look good. And turns out it was. They're called financial planners.
Yeah, did you think at that point that financial planning was going to become the profession that it is today? Like, did you sort of foresee that, or did you think, oh man, this is the end?
No, I could see instantly what the potential was, like from day one. And so the editing concept in the magazine was to treat the readers as if they were already true professionals. To say, of course you do this, and people do you do this in their best interest, and you recommend things based on the financial plan. And, the reality was they were doing a financial plan, and the financial plan just happened to recommend a whole lot of cash value life insurance. Or, do you like to pay taxes? Well, we've got a solution for that. And here's the plan that will do it. But the concept of planning was always a very valuable element in our society. And I could see how that could be nurtured. And I've been nurturing it ever since. I'm writing a book right now, and I say that on a scale of 1 to 10 of professionalism, here's 1 and here's 10. And 10 is true professional, and 1 is purely in your own interest. I'd say at the beginning, most of the people that I talked to who are financial planners had moved from about 1 to 2. The financial planning moved them to 2, but it was needs-oriented selling. And then Napa came along, and they were fee-only planners, and that moved the scale up to like a 7. But we're still stuck at 8 or 9. We haven't gone over to full professionalism yet. And I hope we'll talk about some of the revenue model issues that I think get in the way of us getting to a 10.
Absolutely. Yeah. I think those of us who came into the industry, maybe in the last even 20 years, don't fully appreciate or recognize how big of an impact, things like the launch of Napa was. And how much that did move us towards profession. We sort of take it for granted because they're here and successful and got a lot of advisors and they're a household name. But what I think they were formed in the 80s, right? And
I went to their first conference. Their first conference was 20 people sitting in folding chairs, taking turns being speakers.
Sounds like a great first conference. So what then led you to launching Inside Information versus, I'm sure you could have gotten a job as an editor at a number of magazines at that time. Well,
the editor who investigates his advertisers is not quite as popular as you might think. But the reason I launched the newsletter was because, I became a freelance writer. I leave, and all of a sudden I'm a freelance writer in this world. And I had things I wanted to write about. I wanted to write about practice management, and people were ahead of the curve, trends, new marketing ideas, all these things that were new and different and better and were part of the evolution of the profession. And nobody wanted to include those articles in the magazines. They wanted to write about this mutual fund or that limited partnership program, or it was all products and investments. So I started a newsletter. I figured that, some people might be interested in hearing about some of these more complicated issues. And that was a big differentiator back then. Now it's not so much, but the differentiator now is I go into more depth, but far more depth than anybody else, literally anybody else. And I respect the reader. You don't spend a lot of time on fluff and puffery in my newsletter. You get exactly what you need to get, no more, no less, and you get in and out. That's the goal. So my differentiator have evolved over time.
Per your LinkedIn, you started Inside Information in 1991. I feel like newsletters were, that was like very new, this like kind of new concept. How did you get out in front of advisors? Like, were you on the speaker circuit quite a bit, going to conferences? I guess, how did you sort of get that initial that initial work done?
I think all of my first subscribers came when I went to the ICFP retreat. Somebody came up to me and said, I apologize, you're a lot deeper than I thought you were. And so I must have impressed people by asking the right questions and talking to advisors about what they were doing and how they were doing it and trying to figure out what I could write about. And the retreat back then was a very cerebral affair. It wasn't like a big party. I think sometimes it's moved into a resort kind of a environment. XYPN has kind of taken over that retreat mantle, if you will, where we're there to do business and the business is to get better at what we do and find out where we're going. The retreat back then, the people there recognized something in me and in my writing that allowed me to put food on the table.
Yeah, I definitely agree. What's so interesting about what's now the FPA Retreat is that it's kind of the same group of advisors who were there when you're talking about it. They've been going for 20, 30 years. and their lives have changed. I mean, at its core, they have more money. Like when you first start out and paying $200, $300 for a conference ticket seems like it's going to break the bank. That it's going to be a very different experience versus when you show up and like you sort of have an unlimited budget and can spend whatever you want to enjoy yourself. And there's nothing wrong with that. It's just the cohort, the sort of their target market has evolved over the decades as well.
Yeah, the retreat gentrified alarmingly when it moved out of the college campus onto a location. People are just tired of sleeping on college dormitory beds.
Yeah, I can imagine so. So you talked about how the financial planning has evolved in from a 1 to a 7. Maybe we're at an 8, 9, which I might, depending on how you answer this, I might feel is a little generous, but we'll call it that. What makes us a 10? When you think about however many years out we've got to go to get there, like what makes us a true profession in your mind?
Well, there's a lot of things going on right now that are moving us in that direction. If we talk about technology, I'll address some of that. But I think being a true profession, you have to have several things. You have to have fee for service. So the AUM, I've been talking to people and saying that the asset under management revenue model is just not the future, and it's not what anybody else charges as a profession. There's no other profession where somebody says, how much am I going to pay? How much money am I going to pay for your advice? And the answer is, I'm not sure. How much have you got? That's not a profession. A second is having specialties, having specializations, and I don't really think anybody is ever going to define all the specializations that are possible. It could be certain kinds of expertise. It could be certain kinds of needs. It could be certain industries or professions. But you know it when you're speaking an idiom that only you and they understand. You know it when they walk in your door and you understand already some of the bigger challenges they face. You know it when you're not reinventing the wheel every time somebody walks in your office. And a true profession has people who know more about specific issues and clients than anybody else, and than a generic person. Now, there will still be general practitioner advisors, but we have to have specialists in order for this to be a profession. And then, the whole comprehensive thing has been, I think, turned on its head. They used to have, as I said, I'm writing this book now about what it was like to be in the early days. And I said that, I don't think anybody in history ever read from cover to cover a financial plan written before like 1990. And I sincerely hope that nobody ever dropped one on their bare foot. Because, and so comprehensiveness, I think, is a kind of a smokescreen. You sit down with someone and you find out, who are you? What are you trying to do? Tell me your story. What are the issues that you're going to be facing? And then we will address those and we'll put them in context. But what I don't think people want is they come in and they say, my chest is bleeding, or more specifically for financial planners, I've got a fairly big tax problem and I'm going to inherit some money. And the financial planner responds with, well, we're going to do a comprehensive financial plan for you, which will include this, that, and something else. That's not what they're asking for. What they're asking for is they went to the hospital and the hospital said, we're going to do a total workup on you. It'll take 3 days. And by the way, we might staunch the bleeding somewhere in, the second day or something. So, and finally, a profession it offers its services to everybody. There isn't anybody who doesn't need medical services, and I'm not sure there's anybody. I see people living on the street who would have benefited from financial planners. So, this thing about we have minimums now. And this is my generation. My generation would work with anybody. Fog a mirror. Here's a mirror. Fog it. All right, you're a client. And now, we have these $2 million minimums. And where did they come from? Wait a minute. You were, but you're not complicated enough for us. There needs to be a solution for anybody who walks in the door if you're a financial planner, or you need to refer them to a specialist who knows that stuff. Those are the hallmarks of a profession. You also need a credential, and you also need educational background, but we're working pretty hard on those. I think those are up around 9.
Yeah, I just went to a new barber recently, and he was telling me that they had to do over 1,000 hours of cutting hair before he was allowed to go work in an actual shop. 1,000 hours.
Yeah.
And I'm like, it's so interesting that somebody who cuts hair for a living has higher regulatory standards than we do as financial advisors when we can manage, their life savings, which is it's just fascinating. One thing you mentioned, though, is that, this move from what I would call modular planning, which is really how the profession started. We did a little bit of estate analysis, or a little bit of tax analysis, a little bit of investments, and then we started doing comprehensive planning because we saw the value. I'm sure doctors see the value in doing a full workup for every client. But to your point, that's not necessarily what they're asking for, and possibly can't afford that, because that full workup is a lot more expensive than the acute problem that caused them to come to your office. So do you think the future of financial planning is the pendulum going to swing back to modular planning, where we really treat acute issues? Do you think we stay comprehensive, or is it going to be some blend of the two?
Well, I think the first thing you need to do is stop the bleeding. And so whatever the client's presenting symptom is, you say, yes, we're going to work on that. And the more comprehensive firms can say yes to more things. So somebody comes in with an estate issue or a tax issue or an investment issue or a retirement issue. If you do all those things, then you can say, yes, we do that. And you do that for them. You don't say, all right, you came in with this specific issue, and we're going to do this much broader thing that you don't really understand. But I do think context matters. You need to know more about them than just the presenting symptom. You need to know, their wealth, their proclivity for investments, other things. But those are not what you should focus on, and that's not what you should. I think it goes back to selling. Financial planners are selling what they want to sell, not what clients want. And so, when I say I don't think it's modular planning. I think it's focused planning in context. And the context matters, but the context is not what you sell. The context is what you acquire as you get to know this person.
Yeah, it is so interesting, because like a consumer, I've never met any consumer who woke up on a Tuesday morning and said, you know what I want to do today is go talk to a stranger about money. Like, it's the last taboo. Like, to get someone in your office, something has to have happened. There has been a catalyst event. Sometimes it's a positive event. A lot of times it's a negative event, but something has happened. And, and yeah, when I'm here for one particular issue and then we got to solve all the issues, I do find financial planning to be overwhelming, but I also understand, as someone who was just taught that comprehensive planning was the only way to do it, it's hard to imagine treating the chest wound without doing all these other tests and understanding the full picture, even if that is what the patient's asking for, or client's asking for in this scenario.
Well,
we had a question.
Let me posit somebody who comes to you age 30, they're about to get married, and you say, I'm going to do a full-blown financial plan for you, and 2 weeks later, it's irrelevant. It's not gathering all that information is great, but the planning is an ongoing process. So knowing something about them, you're going to get married, you're going to have kids, you ask a few follow-up questions. And as that person evolves, and particularly this is why it's so difficult to work with younger people, is because they've got so many more moving parts and they've got so many more evolutions. They won't be the same person 40 years from now that they are today. And you theoretically will see them through all of those changes. A financial plan doesn't do it.
So we had a question from the audience related to this point about sort of having a barber and how that profession works, or how you become a barber. Do you think in order to be a real profession, to get to a 10, we have to have a mentorship, apprenticeship path for new entrants? And because I would argue, like, most of them, they're not optional, they're required. So, I mean, we don't even have an optional version, much less a required version, but just curious your thoughts on sort of the mentorship, apprenticeship side of it.
Well, I think what you get to is the coaching aspect of it, where somebody is, or mentoring, where somebody is allowing somebody to learn from you what you do. The medical profession has a residency where it's basically focused mentoring. It's also insomnia there or lack of sleep. So I'm not sure we need to incorporate that part of it. But the idea that anybody who is going to give advice should go through a process of learning how other experts give advice. I think there's great merit in that. I think we should, and there is a residency program, but it's not anything like what the doctors do right now, what the FPA has created. It seems to me though that, and maybe we'll get to this at some point, but a lot of the people my age, the people who look like me, were a little bit greedy when they started their firms. They scaled back on hiring. They didn't spend their time with their staff. And now all of a sudden you're starting to see younger advisors running staff-centric advisory firms. And a staff-centric advisory firm is we're going to grow a forest. Instead of a big oak, we're going to grow a forest. And the forest is going to be a bunch of very good financial planners who all have the expertise and maybe their own specialties. And the advisor who started the firm is not responsible for, or it takes responsibility for their careers. And I just don't think that enough of that was done at a time when it was very necessary in the profession, and we're now suffering from it. And that's why all this consolidation is happening. You were asking about trends.
Yeah.
I don't have a lot of successors because I didn't mentor people. I didn't hire people. I didn't bring them on. I wanted to keep all of the revenue for myself. I wanted to have 70% profit margin. And the 70% profit margin means you've got to sell out. And then there are some really interesting trends that follow up from the consolidation and selling out.
Yeah, I totally agree. It's really interesting to see how valuations are evolving over time and how that impacts the profession, because I agree with you. We sort of have this gap there. I mean, there was sort of a multi-decade gap where we just weren't developing advisors. The number of advisors in their like late 40s, early 50s is really small. It seems like they just weren't there. And a lot of times they got hired and they just were like, no, this is terrible. And so they went off to go do something else. I think your point is valid that many of us, myself included, started a financial planning firm because we had a bad boss and we didn't want to ever have that scenario again. What that also means is that we may have never actually seen like actual management modeled. I was not developed or mentored, so I don't know how to do that for someone else. And so we leave situations because of bad managers, and then we become bad managers ourselves. And you have to grow to a certain point before you can hire good managers. And so I do think that's part of it is just I guess maybe my question is, do you think that is indicative of just the reality of having such a fragmented industry where we have a lot of solo practices, there's a lot of different firms versus sort of the broader, the bigger firms that maybe some professions have?
Well, the more interesting question, I think, I actually did a presentation on what I think the spectrum of size of firms will be. And all I had to do was look at the accounting world and the legal world. There'll be 3, 4 extremely large national firms. There'll be 50 to 75 fairly decently sized regional firms. And then 300 or so firms that pretty much dominate their marketplace. And then the 70% of all of the financial planners, like all of the lawyers and all of the accountants, will be in relatively small firms running their own practice. That's the way we're trending, and I think you can see it. But look at what's happening with PE. PE is like this disruptive force that has kind of hijacked this procession of creating this stable balance of large, medium, and small. And so, picture now let's call him the greedy advisor. He looks like me. Do I look greedy enough to pass for that greedy advisor? I'm not. I'll work on it. And he hasn't hired. He hasn't invested in his own firm, but he's got 2 or 3 people who thought they were going to inherit the firm as successors. And then he gets a really big offer from a PE-backed firm, and he sells the firm, and the successors who were the future of the firm are now employees at this large firm. The large firm looks to them like a wirehouse. It employs advisors. It has standardized advice models. It has certain model portfolios. It charges a certain way, and it expects to have a very different relationship with the clients. It's a how much money can we make on these clients? And so those disgruntled younger advisors who are, got screwed. That's a technical term that we use in the media sometimes. They got screwed. And now they're not going to inherit the firm, and they look around and they say, I'd be better off running my own firm, and they repopulate the smaller firms, but with a different twist. They have a network of clients that they have been working with for years, who the larger PE-backed firm is trying to turn into. It's trying to replace the client relationship it took 10 years to build in 6 months. And there are going to be clients who say, screw that. I got that's another technical term. That screw that thing. I'm going to work with somebody I've known for 10 years, and he happens to run a smaller firm. And so you get these smaller firms that have a different, more service-oriented model, that have learned how not to do it and will follow a different path, which they believe is how to do it. And they're going to change the revenue model, because when they talk to clients, they're going to say, you're paying X amount of dollars. Did you know that? No, I didn't know how many dollars I was paying. Well, that's, if you multiply your net worth by 1%, that's what comes out with the dollars. I'll show you this on a calculator if you want. And then they say, we charge for the services we provide. And it could be a flat fee, it could be hourly, it could be whatever, but instead of them making money when they sleep, I'm going to make money when I work. And everybody who's not a baby boomer who hears that message prefers it. And so those smaller firms are going to be like sharks swimming around. What do the sharks swim around? Something large, and not like a tuna. And the tunas, they get bigger and bigger and bigger, but they're not competitive like the sharks are. So I see a very different, and that's finally going to drive the revenue model thing that we probably should be talking about.
Yeah, that's where I want to go next. I do think the valuation stuff has been really interesting. Obviously, things have changed in the last 18 months, just as the private equity purse strings have tightened up a little bit, which is interesting because they have more cash than they've ever had, but they are investing in fewer things. But at the height, I mean, there were big firms being sold for 17 times EBITDA, 17 times net income, which means they have to own that company for 17 years just to get their initial investment back. That's no actual return.
Well, unless they make the clients more profitable.
This is true. They can drive profit. I mean, they can try to grow revenue, but then those firms, if you look at the studies, they have no organic growth model. Their only growth model is by buying additional firms, which makes it really hard to excuse those valuations. But it also means that the internal successors, even if you have someone internally you want to sell it to that would love to buy it, which is rare enough, they can't afford it. No bank is backing a 17x a net margin valuation. It's not worth that that the collateral that it would take. So it has been a boom for XYPN because we got a lot, to your point, you got a lot of folks who are leaving saying like, okay, fine, I'm not going to do this again. Like, I'm not going to go be a failed succession plan a second time. I've already done this for 10 years.
Mm-hmm.
So switching gears, talking about fee models, you've long been an advocate for what Cerulli likes to call non-traditional fees, which is non-commission, non-AUM. So basically what XYPN does. And so you've been talking about how this is a better value proposition for consumers. It's the direction the profession's headed, but AUM seems to not be going anywhere. It's still remaining very strong. So why do you feel like the AUM model has been so embedded and hard to remove? And also sort of what do you view as the future of AUM and these other business models as the profession continues to evolve?
Well, when I used to look at AUM as the savior of the profession because it converted commissions to fees, and we had to move to fees because there is no profession that makes its money by selling stuff, particularly not garbage, which I think is what was mostly being sold. I remember when there was a big cube with $100 bills blowing around inside it, which I'm not sure what message it was conveying, but greed was a part of it. Greed should not be part of a professional relationship. So, but when I look at AUM, I have trouble telling a difference between AUM and commissions. How much are you bringing in? All right, this is how much you're going to get. It's a trail commission, basically. And a trail commission model goes right back to the sales culture that we haven't completely emerged from yet. And so that's part of why we're, at a 7 or an 8 right now, is because we still have artifacts of the sales culture. And so, when the brokerage firms happily adopted the AUM model, that got my attention. Because they said, "Oh, this is great. We'll pay, our reps however, based on how much they gather." And gathering assets was the name of the game, and I don't think it's that different. I remember going to a financial planner once years ago, and I sat down across the desk from him, and he buried his nose in my portfolio statements. And he wouldn't even look up to meet me in the eyes, and he was talking about my portfolio, and that wasn't what I came to see him for. And it should not be that every single prospect who knocks on somebody's door just happens to need the advisor to manage their assets. And that's how we get paid. That's not. So there's that. I think it's the sales culture that's still lingering in the profession. But we also need to kill off the baby boomers. And being a baby boomer, I'm not really eager to like make that a national trend or anything. But the baby boomers grew up with AUM. They're happy with it. They tend to be the wealthier cohort. They tend to be the clients of these large PE-backed firms. They're not pushing back. And the advisory firms I talk to, well, if there's no pushback, then why should I adapt? Well, sooner or later, those clients are going to die, and the next generation is going to come along, and they're going to say, we're not going to go along with this AUM thing. And if you're not ready for that, then you're not really ready. And the other thing is, most of the firms I talk to, they're not talking to the younger cohort of the blue ocean, as they call it. And I think that means they're going to be walled off. There's a story an advisor told me once years ago. It's a great story. He said that somebody came in to meet with him, and the guy looked depressed. And he said, I just want to make an observation here. You don't look like you're really happy to see me. And he says, it's not that. He said, I'm expecting you to reject me as a client. And he said, why is that? And he said, I don't have any money. Well, why don't you have any money? He said, I own a small business, and all my money goes into the small business. I'm not here for you to manage my assets. And so the guy figured out a way to work with that person, as you can imagine. There are a number of options you can use. And he worked with them for 20 years, and the guy sold his business for $40 million. And now that $40 million, this advisor is managing. And so the advisor who's telling me this story says, this client had been rejected by 3 other advisors before him. And so that's why he was expecting to be rejected once more. So the advisor said that about a week after the announcement of the sale of the business, and that he was going to be the manager of the assets and the financial planner, this other advisor came to him and said, how did you get that client? I specialize in people who sold their business for $40 million, and I manage their assets, and and that's my target market, and that's who I work with. And you ended up with somebody that should logically be with me, right? Turns out that was one of the people who had rejected him 20 years ago. And I think that story is going to play out 1,000, 100,000 times, where you pick up the client relationship earlier, pick the fruit before it's ripe, if you will. And then when the fruit ripens, you are that, I'm stretching an analogy here, but you're that client's advisor.
Yeah, I mean, the argument that I hear in response to that, because I see that all the time in terms of how those client relationships, we generally stay with our advisor. We don't move from the advisor who took us when we were small to the $1 million advisor when we hit $1 million. We tend to stay with our advisor. But that would imply maybe that, or some of the pushback would say that implies that, the flat fee model, fee for service works because there's an AUM kicker on the back end. And I'll work with you now for a fee because in 20 years, I'm going to be able to manage that 40 million, sort of get paid back for my investment. How do
And
you
that was the
respond to that?
point. That was the point of that story. And I think that you're right. That's not the way it's going to go in the future. So your question
Yeah.
was, what is the payback as you work with these clients?
Well, is that the purpose of fee for service? Is the future that fee for service is ultimately the lead gen for AUM and gathering assets and ending up on an AUM fee? Or do you see firms in the future that a flat fee or retainer fee, whatever that fee for service model is going to be for all their clients? It's not going to be variable based on their assets.
I think it's going to be variable based on their complexity, which means the fees are going to grow as the assets grow. But I don't think if we were to fast forward 20 years and be talking now, and doddering me would be, dribbling and staring at the screen, we would be saying, it's really interesting how so many of the established firms had trouble making that transition. And they couldn't make that transition because they were so invested in this. And we're going to say, managing client assets is really, it's part of the advice. It's not something where you're making all your money from that. It is, you tell them, here's a portfolio, here's how we rebalance, here's what needs to happen, and you control the assets. And it was just like all the commission guys when the fee only thing hit. Most of them didn't really adapt very well. Selling limited partnerships was easy. Do you like to pay taxes? If you did like to pay taxes, then that probably wasn't a good prospect for you. But the answer was invariably no, of course not. So adapting to actual professional advice and managing assets in a different way, not selling assets, but managing them, was very difficult. Adapting from AUM to, I think it's inevitable, fee for service on some level is inevitable. The question is, are you experimenting with that now? Are you doing it now? Are you making it happen now? And yes, I think the payoff at some point in the future is that client becomes reliant on you to take care of a lot of the stuff that they just don't want to do, and they're willing to pay more for it as they can pay more for it.
Absolutely. So I'm going to put you on the spot. I did not prep you with this question. I'm curious if you can think of a time when you think back about something you predicted was going to happen in our industry. No one listened and ended up being right. Like, did you have any predictions that you look back, you're like, yep, nailed that one? Wish some folks had listened to me earlier.
Well, I have a fairly stunning positive track record on predicting the future. I predicted that fees would be the future of the profession. I said that managing assets was managing no load mutual funds was going to be the future. I predicted any number of things about software, including the idea that the CRM was going to be the heart of a planning program. But the methodology I used was not extreme brilliance. I don't know if you can see my brains, but they're not any bigger than anybody else's, and more often than not muddled. What I would do is I would interview people who seemed to me to be living in a future. They were doing things differently from everybody else, and it worked. And my definition of what the future is going to be is something someone's doing now that works. And so I would, over and over and over again, I would profile people who were doing things that were working. And that, it was, certain practice management models. I'm trying to think of a good example of it, but I profiled Angie Herber's Diamond Team model. I was the first person to write about it. It was some of what you would call predictions, I would call being the first person to write about them. And
yeah, I like that. I like that definition that predicting the future is just talking to the people who are already doing the new thing, basically.
Yeah. Well, if I could see the future, if I claim to see the future, I'd have to wear a wizard's hat. I'd have to have a crystal ball in front of me, and that's not my business. My business is, there are people who are doing stuff that's really cool and interesting and better, and I think more people should know about that. The evolution is driven by people like me. The evolution forward is driven when people become exposed to really interesting, new, cool ideas, and then experiment with them on their own and make them even cooler.
want to switch the conversation and some of these questions around over to technology because the kitsis.com tech map has become infamous. It just continues to grow. Now there used to be just technologies I hadn't heard of. Now there's categories I hadn't heard of before I looked at his map. So what do you see as sort of the evolving role of technology in our profession? Are we getting replaced by these new technology tools, or is there something we can do to sort of embrace it?
Yeah, I joked at the last conference I spoke at that the next conference they come to, there's going to be a computer on this chair that I'm sitting in, and a computer on that chair that Joel Bruckenstein is sitting on, and a computer in the other, and they're going to be having a panel discussion, these computers among themselves with the AI programs. I had a lot of conversations in T3 about AI. So that's the new sexy thing. So we can talk about that first. But I came away with the impression that AI is not going to be doing our thinking for us anytime soon. But what it will do is it will revolutionize software in two ways. The first is the user interface. Most of the software programs, they bolt on all these new features, and then it becomes so complicated you can't navigate them all. And then they come to me and they complain that people are only using about 40% of the capabilities of their software. And with AI, where you can just speak to the computer and say, I want to do this, the user interface becomes dramatically better, easier to navigate. And so what that will do is not only will advisors start using the full 100% capability of their tech stack, but the companies that have been reluctant to bolt on a bunch of new features because it makes their program so complicated are now untethered. They can bolt on whatever they want, and AI will tie it all together, and AI will guide you to it. And remember, AI also makes programming much simpler. So all these cool features that are on the drawing board are just going to suddenly emerge and burst onto the scene. And then I think the other area that everybody points to in AI, I think, is evolving in a different way. I think the whole financial planning software suite is due for a radical shift. You look at the brand X products, Money Guide Pro and eMoney and Right Capital, and really they're glorified spreadsheets. They have a Monte Carlo engine bolted on. They have a couple of other calculators bolted on, but fundamentally they're, if you were to, in fact, they came from spreadsheets. I was around when spreadsheets were invented, if you could imagine that. VisiCalc was a really cool program. Nobody remembers it now. But now you've got this new explosion of better ways, I think, to evaluate a client. Libretto completely redesigned how you evaluate somebody's financial assets and their progress toward their financial goals, and how you define their goals, and how you build a portfolio based on how those goals are defined. And the program includes your human capital discounted at a certain rate, but if you buy a certain amount of disability insurance, it's discounted at a lower rate, and so you get you get the amount of disability and life insurance you need just based on that discount factor. And then you have Elements, which provides that weekly or even daily view of progress that a younger family is making as a result of the advice they're giving. Income Lab is fantastically more sophisticated than the Monte Carlo engines that are out there for discussing retirement planning, retirement decumulation, and what can be decumulated, if you will. You've got conquest planning using AI, not to calculate, but to anticipate what is needed next in the plan. FP Alpha drives planning in a whole bunch of different new directions. Holistaplan is the best tax planning engine ever. And now I think the whole idea of financial planning is not a comprehensive financial plan that's a spreadsheet, but 3 or 4 modular products that do a much deeper job, a much deeper dive, each into the advice model. And in the middle of that is AI, I have to say.
Yeah, it's so interesting. If you look back, 20, 30 years ago when we were financial advisors, the typical firm was a lead advisor, maybe an associate advisor. and then like 12 staff members,
Mhm.
because the back office was the real, challenging part of our business. It was really time consuming, and that advisor worked with 75 to 100 clients. Fast forward to today, and now it's an advisor with maybe half of a staff member. Got someone part-time or fractional, working with 75 to 100 clients. So the interesting metric that really hasn't moved is number of clients. Revenue per client is up. I think value we're delivering is up, more services. But the back office has gotten disrupted, but the advisor relationship model doesn't seem to be disrupted. And so do you think that's the next evolution? Are these tools going to allow advisors to suddenly work with 300 clients, which would theoretically let us start working with clients who can't afford advice today? Or do you think we are forever a profession that just has a 75 to 100 to 1 client to advisor ratio?
My take on that has been for years that most advisors are wasting a lot of their time and their clients' time. We meet 4 times a year and we go over your portfolio 4 times a year. We ask you if there's anything else going on in your life. And really, the clients know when they need help. They know they need advice. You don't go to the doctor 4 times a year scheduled. You go to the doctor when you need the doctor's advice. And meantime, the doctor is monitoring things. I had a rash of poison ivy not long ago. It damn near killed me. And I called my doctor, and the doctor called in a prescription, and I was okay again. I didn't need a lot of the stuff that financial planners are selling, if you will. So to me, the world of financial planning is going to get much more, I'm not sure what the word is, much more opportunistic, if you will. There's a problem, let's solve it. No problem, we're not going to hear from you. You're not going to hear from us. We may send you stuff periodically, like here's an alert, the markets just went down, or here's an alert, there's a new estate planning technique that you may want to avail yourself of, but that doesn't require a meeting. That's a message that goes out on social media and to clients. So yes, I think advisors are going to need to figure out how to leverage their time more efficiently, particularly when they work with younger clients. Because the younger client, I'm getting married, but I don't have time to come in the office 4 times a year. I just want you to tell me I'm getting married, and I also want you to tell me how much I need to save and invest and what the portfolio should look like. And we have a kid, should I do life insurance? Yes, and that's how the relationship should go. You're on call as needed, working in the background to make sure and anticipating the needs, but not wasting a lot of the client's time and not wasting a lot of your time. I don't think it's impossible for advisors to be as leveraged as doctors. I think a good advisor could work with as many clients as a doctor does, as many patients as a doctor does, and that's in the hundreds. And that's just
that's what's interesting. I think I saw a stat on this one time. I think it's average doctor has about 400 to 500 patients.
Yeah.
But when you go to a concierge medicine style where you pay monthly and you get unlimited access, it's about 100. And so it's kind of interesting. It's the service model, right? It's not it's nothing else. It's
but the concierge model, the people who buy the concierge model are typically pains in the neck. You can work with 100 pains in the neck under my model, but I don't think you'd want to.
That's fair. What are your thoughts on sort of the future of the custodian and how that works in the advisor relationship? Because it seems like we're sort of evolving from where the custodian was the centerpiece to now it's more of a they're buying these systems and they're becoming more of a platform, but maybe they're an add-on to a platform. So I guess, what do you see as sort of the future of the custodian, how advisors leverage, those platforms?
Well, you've got two things going on. You touched on one of them. The question Microsoft always had to ask itself is, what is appropriately part of the platform as a feature of the platform, and what is appropriately an independent software solution that plugs into the platform. And the custodians are wrestling with that, and I think some of them are doing a better job of it than others, frankly. I wrote a long article about some of the problems with the conversion from TD Ameritrade to Schwab, and I think Schwab should not get into the technology business based on what I wrote and what I read. But somebody like SEI, they bought a platform and put it out there, and their argument is, why should you have to buy a CRM and a client portal and a asset management platform, if you will, when we can just bolt it right on. Altruist is probably the most interesting custodian right now, and they have a comprehensive asset management platform that they sell independently that is also their custodial platform. Trade PMR has a bunch of that stuff. So that's one trend, is trying to figure out what is appropriately a custodial function as opposed to and I think the trend is going to be, people are going to say more and more are custodial functions. But the other interesting trend to me is the new programs that make it much easier to onboard a client or to repaper a client. It used to be repapering a client. You'd ask an advisor, which would you rather do? Have a root canal without anesthetic or repaper your clients? And it was kind of like that money or your life joke with Jack Benny. I'm thinking, I'm not sure. Maybe the root canal would be less painful. And now you've got these programs that will automatically populate all the paperwork fields. So all the client has to do is answer a series of questions, like a quiz. It's like a questionnaire. And once they answer those, it automatically populates all the stuff that needs to be submitted and makes it all happen. The ACATS forms and the client account opening forms and the new planner relationship forms and all that stuff. So once those programs become more mainstream, and once Altruist has a pretty good, and Trade PMR has a pretty good front end as well, then those relationships are going to be less sticky. It's going to be kind of like, nobody leaves somebody when they're managing your assets because they don't really know how. And it's sort of the same thing with custodians. I'm not sure how I would change. But if it's less painful than that root canal, if it becomes almost pleasant, which it's not quite there yet, but if it does, then those relationships will be a lot less sticky, and there'll be a lot more competition in the custodial marketplace. The FTC, I should add, the FTC contacted me and said, what do you think about this TD Ameritrade and Schwab merger? And the first thing I said was, who told you to call me? What kind of a crazy idea was that? And then I said to him, ultimately it will be less choice in the marketplace, but I think it'll create more competition, because I think there are a lot of people that affirmatively chose TD Ameritrade over Schwab, and now they're at Schwab. They're going to be looking to go to one of these other independent custodians that haven't been getting much traction. So, and they said, thank you, and they did nothing with my advice.
Mine either. They called Michael and I as well. I think it's so interesting.
Was that you that slipped them on me?
Probably. Okay. It's probably like, who do I need to get back at? The interesting thing with the custodial marketplace right now, with Altruist and Trade PMR and some of these other platforms, is sort of when technology and sort of the tech culture meets financial services. And that, in tech, and I've been, part of these builds where it's sort of, go fast, break things and apologize. And that works when you're a CRM and just the advisor sees it and we mess something up, we got to fix it. When a client sees it, that's a whole different story. When I log into my platform and my account balances are wrong, or trades are faulty because the algorithm wasn't fully tested, whatever the thing is, that happens. And so I think it'll be interesting to see how, can the technology providers who are tech-centric and are building custodial platforms, can they slow down enough to build the trust that's necessary with advisors and their clients?
Yeah, that's an interesting question. So basically what you're asking is, will InvestNet be able to become a competitive custodian? That's the best. Orion may be in that category also. And we make most of our money from software, but we also can provide custodial. The custodial platform is really if you talk to people who are creating new software, the custodial, what's the word? The custodial linkage, the custodial integration is crucial. Because somebody on the Schwab platform is not going to use something that's not compatible with the Schwab platform. That's just, And so having the custodial relationship becomes a potential vector for selling software. The custodians, traditional custodians, Schwab and Fidelity, have not monetized that capability and may never. But somebody like Trade PMR, we can maybe develop some software we could sell. InvestNet and Orion, we are in the software business, but if we own that custodial relationship, we would own the advisor relationship forever. So that's the kind of thinking they're doing, and they've actually shared that in various. The problem is that none of the big platforms have managed to make their software integrated more deeply than other software is integrated with their programs. So there's no particular advantage to using them as a platform. They're trying to figure that out too, and I have not been very helpful in my assessment of it. I said, why even bother? Just let everything win on its
The
merits.
custodians are really difficult to integrate with because that technology was built so long ago. I mean, I think it's archaic. I mean, people used to really be happy with VO1 and TD Ameritrade and all of these things, but like VO was a API platform they bought with TD Waterhouse, and they did that merger in the 90s. Like we were still like, we're bummed to lose access to the technology that was made in the 90s when the merger happened with Schwab. So it's so interesting to see, because you can't, I think you're right, you can't survive without the custodial relationship, but the custodians don't really have the technological infrastructure to be a good partner. And so how that ultimately plays out is going to be really interesting.
The hot new company is Apex. John Patullo, who created or oversaw Vail, basically TD Ameritrade, created their new platform. And but you can get pretty much a modern platform with SEI because they rewrote it from the ground up. Oddly enough, RBC rewrote their platform from the ground up. It's expensive, but they felt like they had to do it. So sooner or later, Schwab and Philly are going to have to replace the abacuses with something more modern, and that's going to be a huge commitment on their part.
Yeah, absolutely. So we're coming up on time, so I'll ask just one final question, and that is, particularly because the folks we're talking to, many of them are earlier in their careers, on the first half versus on the backside of their career. So, what's your advice for those younger advisors, sort of that are early in their career? What do they need to be prepared for? What changes are you most worried about for them over the next 10, 20, 30 years? What can they do to prepare for the future?
Well, the first advice I would give is to recognize and charge for the value you provide, and do it boldly, do it without hesitation. But that's easier said than done because you're new and someone you say, here's my fee, and then they inevitably invites a pushback, and you say, okay, and that's the way most advisory firms start. That's the way most young advisors. But it doesn't have to be that way. I talked to an advisor some years ago who had a client. He had a client appreciation dinner, and he had people sitting at a table who all of them had a 40-year relationship with him and his firm. And he said, I looked over at one of them, and she's a school teacher. And I got a hold of her. She became a client when she was young and just about to blow her salary on a new car. And he said, I talked her out of buying that fancy new car, and we put her on a schedule. And now she's quite wealthy. She's got, multiple millions of dollars saved up. She's a squirrel, I think we all know that tendency. And now she's giving back. She's donating books to the school library, and books that she felt like should have been in there in the beginning that would develop a love of reading. And he says, I look at this woman and I think I didn't charge nearly enough for the advice I gave her. I made thousands and she made millions. And I'm not saying that we should turn that around. I don't want younger advisors to say I should make millions and they should make thousands, but I do think that the value you provide is incredibly leverageable. it will over time become something much greater than anything they could pay for. They could pay you. And then if you add, the advice you give on their human capital, how you would, some of the specialized issues, how you would negotiate with this or figure this out, how much life insurance you might need in case there's an issue. All those things become far more valuable over time than you will appreciate now. And if you can't do that, if you can't boldly set your fee or tell clients your fee, have your receptionist set the fee and communicate the fee. You set the fee and someone else communicates it, because to them it's written in stone. They're not going to negotiate. They're not. This is just what we charge, and here's the paperwork.
Yeah, we built a fee calculator module inside of Advice Pay, and it's super basic. It's just, here's what led to the fee, and I input my inputs, my variables, and then it spits out a fee. But it really has helped advisors be like, well, this is just what the calculator says it's going to cost.
Right.
This is just it, even though they're the ones who built the calculator.
Yeah, so you get kind of a third party endorsement, so to speak. Yeah. Mm-hmm.
Well, listen, I know we're up on time and want to be respectful to all of our participants' time as well as yours, Bob. So thank you so much, everyone, for coming and joining us. And Bob, thank you especially for taking the time out of your busy schedule to come hang out with us and talk a little bit about sort of your views of the profession and the future of where we're headed. So thank you for all that you do and for the time today.
All right. Well, thanks for having me.
Thanks, everyone.
Take care.